Welcome to Invest IQ Podcast, your deep dive into the world of residential real estate investment.
Glad to be here.
Today we're tackling something absolutely critical, financing. How do you actually pay for these investment properties?
Right. It's often the biggest hurdle, but also where strategic thinking can really pay off.
We've looked into a whole range of loan types, gathered some expert analysis, and our mission today is really to break down these different financing avenues.
Yeah, we want to explore what makes each one tick, the good, the bad, the nuances.
So you, the investor listening, can get a clearer picture of what might work for you.
And just a quick heads up, of course, this is all for educational purposes. It's definitely not financial advice.
Absolutely. Your best option always depends on your specific situation, your goals.
Couldn't agree more. The best loan is very individual.
Okay, let's jump in. When someone's looking to finance an investment property, where do they usually start? What's the most common route?
Well, typically, the first stop is conventional mortgages. These are the loans most people are familiar with, issued by private lenders like banks or credit unions.
Right, the ones that follow guidelines from Fannie Mae and Freddie Mac.
Exactly. They're the bread and butter of the mortgage world.
But financing an investment property versus your own home, I imagine there are some differences, right?
Yeah.
It's not quite the same deal.
Oh, definitely not. While they're common, getting a conventional loan for an investment property has some, let's say, higher bars to clear.
Okay, like what specifically?
The big one is the down payment. For your primary home, you might get away with 3%, 5% down sometimes. For an investment property, expect much higher.
How much higher are we talking?
Usually in the range of 15% to 25%, sometimes even more. That's a big chunk of capital up front.
15 to 25%. Wow, okay, that's a major difference right there. What about credit scores? Are lenders pickier?
They tend to be, yes. The criteria are stricter. You'll likely need a solid credit score, maybe 620 minimum if you're putting down 25%. But it could easily be 680 or higher if you're closer to that 15% down mark.
And interest rates. Do investors pay more?
Generally, yes. You can expect the interest rate to be maybe 0.5% to 0.75% higher than what you'd get for your primary residence.
So higher down payment, stricter credit, higher rates. Anything else?
Reserves. Lenders often want to see that you have cash reserves on hand after closing.
Like emergency funds.
Sort of. Enough cash to cover potentially 6 months of mortgage payments, principal, interest, taxes, and insurance, or PITI. They want a cushion.
Got it. Cushion makes sense.
And one more thing to be aware of, loan level price adjustments, or LLPAs. These are fees based on risk factors like your credit score and down payment, and they can definitely increase the cost for investment properties compared to owner-occupied ones.
Okay, so conventional loans. Accessible, familiar, but definitely more demanding for investors. What about FHA loans? We hear about those for first-time buyers, low down payments. Do they ever fit for investments?
Generally, no. FHA loans are really designed for primary residences, for people living in the home.
But I thought there was like a small exception.
There is, but it's quite specific. You can potentially use an FHA loan for a property with 2, 3, or even 4 units if, and this is the key part, if you live in one of those units yourself.
The owner-occupant rule.
Exactly. So for a pure investment property, one you're just renting out and not living in, FHA is typically off the table.
Right, so if you're house hacking, maybe, but otherwise, look elsewhere.
Precisely. Lower credit scores might qualify, say, 580 plus with 3.5% down, or even lower with 10% down. But you also have mandatory mortgage insurance, stricter property standards. It's really geared towards owner-occupants.
Okay, so conventional has hurdles, FHA is mostly out.
Mm-hmm.
Let's talk about some perhaps less common, more specialized options. Bank statement loans, what's the deal with those?
Right, so bank statement loans are interesting. They fall under the category of non-qualified mortgages or non-QM loans.
Non-QM, meaning they don't have to meet those standard Fannie-Freddie rules.
Correct. And the key difference is how you qualify. Instead of relying heavily on tax returns, W-2s, pay stubs, you qualify based primarily on your bank statements.
Using bone deposits to show income.
Exactly. Lenders typically look at 12 or maybe 24 months of your personal or business bank statements to verify your income stream based on deposits.
Who would find this most useful? It sounds like it caters to a specific type of borrower.
It's a fantastic option for people whose income isn't easily documented the traditional way. Think self-employed individuals, freelancers, small business owners, investors with irregular income.
People whose tax returns might show lower income after deductions, but their bank accounts show good cash flow.
That's the sweet spot. It offers a lot more flexibility if your income picture isn't standard W-2.
What are the upsides beyond just the income verification?
Well, the flexibility is key. Down payments can potentially be as low as 10%. You might be able to do a cash out refinance up to 80% of the property value.
That's pretty good leverage.
Yeah, and loan amounts can go quite high, sometimes up to $20 million. Debt to income ratios can also be more flexible, maybe up to 50%. Plus, you often get choices like fixed rate, adjustable rate, even interest only options.
That seems really appealing for the right person. Are there catches? Downsides?
As you might expect with more specialized lending, yes, you'll likely face higher interest rates compared to a conventional loan.
Okay, that's common for non-QM.
Right. And the down payment requirement, while potentially lower than conventional in some cases, might still be higher than, say, FHA and could still be substantial. Also, not every lender offers these.
So you need to find the right lender.
Definitely. Finding a lender experienced in bank statement loans is crucial. Qualifications still matter, of course. You'll need a decent credit score, maybe 620 plus, maybe higher depending on the loan details.
And reserves, like with conventional.
Yes, PITI reserves are usually required, maybe anywhere from 3 to 12 months worth, and they'll typically want to see at least a 2-year history of self-employment or business ownership.
Can you use these for any type of property?
They can generally be used for primary residences, second homes, or investment properties, so quite versatile in that sense.
Okay, bank statement loans, a solid alternative for non-traditional income earners. Now, let's shift gears to loans that seem laser-focused on the investment property itself. DSCR loans. What does DSCR even mean?
DSCR stands for Debt Service Coverage Ratio, and you're right, these loans are specifically designed for financing income-producing rental properties.
Debt service coverage ratio. So it's about the property's ability to cover its own debt.
Precisely. This is the key insight. DSCR loans evaluate the property's cash flow, not necessarily your personal income.
How do they calculate that?
It's pretty straightforward. They take the property's gross rental income and divide it by the total debt service. That's the principal, interest, taxes, insurance, and any HOA dues. PITI plus HOA.
So rent income divided by mortgage payment plus other costs.
Basically, yes. A ratio above 1 means the property generates more income than its expenses. Lenders typically want to see a ratio of, say, 1.2 or 1.25 or even higher, meaning the income exceeds the debt service by 20-25%.
And the big advantage is no personal income verification needed.
Often, yes, that's a huge draw. Approval is based primarily on the property's income potential. If you have multiple properties or complex personal finances, this can dramatically simplify things.
That sounds like a dream for many investors. What else makes them attractive?
Well, the guidelines are generally more flexible than conventional for investment properties. It can be easier to qualify if documenting personal income is tricky.
Faster approvals, maybe?
Sometimes, yes, and a really big one. There's often no limit on the number of properties you can finance using DSCR loans. Conventional loans usually cap you at 10.
No limit. Wow, that's huge for scaling investors.
Absolutely. They work for various rental types too, short-term, long-term, single-family, multifamily. You can even get them in an LLC name for asset protection.
LLC ownership is a big plus. And jumbo options available too?
Yes. Jumbo DSCR loans exist for higher value rental properties.
Okay, this sounds incredibly powerful for rental investors.
Yeah.
But there have to be downsides, right? What's the catch?
There are definitely trade-offs. First, expect a significant down payment, often 20% minimum, and sometimes up to 30% or even 40%.
So similar or even higher down payments than conventional sometimes.
Potentially, yes. And interest rates will typically be higher than conventional rates. There's usually a minimum loan amount too, maybe $100,000 or so.
And these are strictly for rentals.
Strictly. Not for your primary residence, not for fix and flips. The property generally needs to be rent ready or close to it.
No fixer-uppers?
Correct. And there's the inherent risk, right? If you have vacancies, the property isn't generating income, but you still have to pay the mortgage.
That's the core risk of rental investing anyway, I suppose.
True. Also, be aware of prepayment penalties. They are very common on DSCR loans. If you plan to sell or refinance quickly, that could be costly.
And unique properties might be harder to finance.
Yeah, if it's tough to find comparable rentals to establish market rent, getting the appraisal and income projection approved can be more difficult.
What are the typical requirements then, beyond the DSCR itself?
You'll still need a decent credit score, usually 620 or higher. You need to meet that minimum loan amount. An appraisal is crucial to verify value and market rent. And you might need cash reserves, especially if the DSCR is marginal, maybe just covering costs, like a DSCR of 1.0. Perhaps 6 or 12 months of PITI reserves in those cases.
So DSCR, great for income-focused rental investors who have the down payment, but higher rates and specific property requirements.
That's a good summary. It's a powerful tool in the right situation.
Okay, let's pivot slightly. Many investors already own property, maybe their own home or other rentals. Can they tap into that equity? Let's talk home equity loans and HELO tests.
Yes, using home equity is a very common strategy. You can take out a home equity loan, which is a lump sum fixed rate loan, or a home equity line of credit, a HELOC, which is more like a credit card secured by your property, usually with a variable rate.
And can you do this on an investment property, not just your primary home?
It is possible, yes, but it's generally harder.
Harder. Why is that?
Lenders tend to view rental properties as riskier collateral than a primary residence. The thinking is if you hit financial trouble, you'll prioritize paying the mortgage on the house you live in before the rental property loan.
So they tighten the requirements.
Significantly. To get a home equity loan or HELOC on an investment property, you'll typically need a stronger financial profile overall. Higher credit score, maybe 700 plus, lower debt to income ratio, perhaps capped at 43% or 50%.
Lower LTV too, I bet.
Definitely. They won't let you borrow as much against the property's value, maybe a maximum loan to value of 75%, and they'll likely want to see substantial cash reserves, maybe 6 to 15 months of payments for that property.
Wow, 15 months. That's a lot of reserves.
It can be, yeah. They might also scrutinize the property's income performance, its cash flow, occupancy history. They want to see it's a stable asset.
So assuming you can qualify, what are the benefits for an investor?
Well, the funds are flexible. You can use that equity for pretty much anything: down payment on another property, renovations on an existing one, whatever you need capital for.
And potential tax benefits.
Potentially, yes. If the loan proceeds are used to buy, build, or substantially improve the property securing the debt in this case, the investment property, the interest, might be deductible. But tax rules change, so always consult a tax advisor.
Right. Disclaimer noted. And ELOCs offer that draw as you need flexibility.
Correct. ELOCs give you access to funds over a period, which can be useful if you have ongoing project costs or aren't sure exactly how much you'll need up front. Home equity loans give you the certainty of a fixed rate and payment.
What are the main risks or downsides, besides the tough qualification?
Well, you're adding another lien onto your property, increasing your overall debt load. ELOCs typically have variable interest rates, so your payments can go up.
Rate risk, yeah.
And both types of loans generally need to be paid off if you sell the property. Higher rates and extra fees compared to a primary home ELOC are also likely.
So using equity is an option, but comes with higher hurdles and risks when it's an investment property providing the equity.
Exactly. Powerful, but requires strong finances and careful consideration.
Okay, moving on. Portfolio loans. These sound a bit different. What makes them distinct?
The key difference is right there in the name almost. Portfolio loans are kept in-house by the lender. They stay on the lender's own portfolio of assets.
Unlike conventional loans that get bundled and sold on the secondary market to Fannie Mae or Freddie Mac.
Precisely. Because the originating lender, maybe a local bank, a credit union, or a private investment group holds onto the loan, they aren't bound by those strict secondary market guidelines.
Ah, so that means more flexibility.
That's the main advantage. They can set their own underwriting rules. This can be huge if you have a unique situation or a non-conventional property that doesn't quite fit the standard boxes.
Like what kind of situation?
Maybe a property that needs significant renovation or has mixed-use zoning, or perhaps you have a slightly unusual income situation that conventional underwriting struggles with. Portfolio lenders might be more willing to look at the whole picture.
So potentially tailored loan terms.
Yes, they might be able to structure terms to fit a specific investment strategy. Sometimes closing can be faster because there are fewer external hoops to jump through.
Could they offer higher LTV for rehab projects, maybe?
It's possible, yes. They might finance a wider range of property types: residential, commercial, mixed use, and a big one for some investors. They might let you bundle multiple properties under a single portfolio loan.
Okay, that bundling sounds efficient for investors with several properties.
You can definitely streamline things.
But, like always, there must be drawbacks. What are they for portfolio loans?
Typically higher interest rates. That flexibility comes at a cost.
Makes sense.
Also, the eligibility criteria are non-standard. They vary hugely from lender to lender, so you really have to shop around and understand each lender's specific requirements.
No universal checklist then.
Not at all. You might also find shorter loan terms, maybe 5, 7, 10 years, often with a balloon payment due at the end.
Balloon payments. Got to be ready for those.
Absolutely. And they might still require higher down payments compared to some other options.
So who is the ideal investor for a portfolio loan?
It's often someone with unique needs. Maybe you have that non-standard property, or you want that multi-property loan, or you have a strong relationship with a local bank that offers these.
Yeah.
Eligibility really depends on the lender's assessment of your credit, your experience as an investor, your cash reserves, and the property's potential.
Okay, portfolio loans. Flexibility, but higher cost and variable terms.
Got it.
Now, we should probably briefly mention a couple of other options often talked about. Hard money and private money.
Right. These are usually much shorter term solutions. Hard money loans are asset based, meaning the loan is secured primarily by the property itself, not so much your personal creditworthiness.
Often used for fix and flips, right?
Right.
Where speed is key.
Exactly. They come from private lenders or specialized companies. Approvals can be very fast, but the rates and fees are typically quite high. Think bridge financing.
And private money.
Private money is similar, but usually comes from individual investors, maybe people, friends, family, other business contacts. Terms can be very flexible, negotiated directly, but again, potentially higher costs and risks depending on the arrangement.
So short-term, high-cost options, good for specific, quick turnaround strategies.
Generally, yes.
Mhm.
Not usually for long-term buy and hold rentals.
And then there's the simplest option of all.
Cash.
Right, just paying cash.
And it happens more often than you might think. A significant number of property purchases, including investments, are all cash deals.
Huge advantage in competitive markets, I assume.
Massive. A cash offer is strong. No financing contingency means a faster, more certain closing for the seller. It can often win you the deal, even if your offer isn't the absolute highest.
No lender hoops, no appraisal worries, just straightforward.
If you have the capital, it's definitely the simplest route.
Okay, so we've covered a lot of ground. Conventional, FHA, limited, bank statement, DSCR, home equity, portfolio, hard private money, and cash. That's a diverse toolkit,
It really is. There's likely a financing solution out there for almost any viable investment strategy.
which brings us to the $1 million question, or maybe the $100,000 question, depending on the property. Which options are best for return on investment, for ROI?
The ultimate goal for any investor. But the honest answer is, it depends.
No single magic bullet loan for the best ROI.
Unfortunately, no. It's heavily dependent on so many factors. Your specific strategy, the property itself, the market you're in, interest rates at the time, and crucially, your own financial situation and risk tolerance.
Can you give some examples of how different loans might play out for ROI?
Sure. Let's think about upfront costs. A loan with a lower down payment, maybe like that FHA option for an owner-occupied multi-unit, or potentially some bank statement loans, might seem like they boost initial ROI because you have less cash tied up.
Right, leveraging more.
Yeah. But those loans might come with higher interest rates or mandatory mortgage insurance, like with FHA. Over the long run, those higher carrying costs can eat into your cash flow and reduce your overall ROI compared to, say, a conventional loan where you put more down but got a lower rate.
So it's a trade-off between upfront capital and long-term cost.
Exactly. You have to model it out. Now, DSCR loans are interesting because they're designed around the property's income potential.
Their whole premise is ROI focused in a way.
Pretty much. A strong positive DSCR where the rent significantly covers the debt service is fundamental to good rental ROI. The loan structure itself forces you to analyze that income potential up front.
What about using home equity? How does that impact ROI?
Well, if you pull equity out of property A to buy property B, the ROI calculation gets more complex. You need property B to generate enough return to not only cover its own costs, but also the cost of the equity loan on property A.
So the new investment has to be profitable enough to justify the cost of borrowing the equity.
Correct. It can be a great way to scale and boost overall returns if done wisely, but over-leveraging borrowing too much against your properties significantly increases risk. If property B underperforms, you could jeopardize both properties.
Okay. And portfolio loans. You mentioned they might have higher rates.
They often do, which can dampen ROI on the surface. But if a portfolio loan allows you to acquire a unique property with high potential that you couldn't finance otherwise, or allows you to close faster and beat competitors to a great deal, that flexibility could lead to a much higher ROI in the end, despite the higher rate.
So it enables opportunities that might otherwise be missed.
Potentially, yes. Same idea with hard money. Very expensive, right? But if it lets you flip a house in 3 months instead of 6, and the market is hot, That speed can dramatically increase your profit margin and annualized ROI, making the high cost worthwhile for that specific deal.
It really sounds like you need to run the numbers for every single scenario.
Absolutely. There's no substitute for a thorough financial analysis. You need to project realistic income, estimate all costs, the loan interest, fees, closing costs, insurance, taxes, maintenance, vacancy reserves, and compare how different financing structures impact your bottom line, your cash flow, and your projected return over your intended holding period.
So the best ROI option is the one that fits your numbers and your plan for that specific property.
That's the bottom line.
This has been incredibly useful. It really highlights just how diverse the financing landscape is for residential real estate investors.
It truly is. There are more tools available than many people realize, each suited for different needs.
And it underscores the importance, really, of understanding the details, the pros, the cons, the requirements, before you commit to a loan.
Absolutely. Knowledge is power here.
Mhm.
Making an informed decision on financing is one of the most critical steps in successful real estate investing.
And just to reiterate what we said at the start of this InvestIQ podcast deep dive, what we've discussed today is an overview. It's meant to educate and inform.
Right. It's not specific advice. You really need to do your own homework, talk to lenders, and ideally consult with qualified financial advisors or mortgage brokers who understand investment properties.
Get that personalized guidance based on your unique circumstances.
Couldn't stress that enough.
So, as you, our listener, think about your own real estate goals, maybe your next venture. Which of these financing pathways we've discussed today seems like it might hold the most potential for the returns you're looking for?
And what further questions do you need to ask to figure out how to make that pathway a reality for you?
That's the key thought to take away. Really consider which tools fit your strategy. Thanks so much for joining us for this deep dive into real estate financing.
My pleasure. It's a complex but fascinating topic.